Hello, this is Andrew Samalin of Samalin Wealth. Real estate is a favorite asset class for investors, both as part of their personal balance sheet through the ownership of their primary residence or vacation homes, or as part of their investment portfolio using different instruments. I'm going to steer away today from whether or not the viewer should invest in real estate. That's a personal decision that you and I will explore separately from a planning perspective. This video is going to describe potential methods of investment in real estate and their characteristics. Specifically, we're going to compare the difference between REITs or real estate investment trusts and private equity real estate funds. Yes, I know the excitement is building. As a quick primer, REITs are investments that hold only real estate properties or real estate debt. REITs invest in most property types, including apartment buildings or malls or cell towers, hotels, data centers, medical facilities, offices, and distribution centers like those that Amazon use. They're required to pay out 90% of their net operating income to shareholders just like you and me. Most REITs are publicly traded stocks, which make them highly liquid, which is unlike their physical real estate investments. Private equity real estate, which includes hedge funds that focus on real estate, are generally private. They're illiquid partnerships managed by a general partner who shares in the upside of the fund's performance. So what are the differences between REITs and private equity real estate? Well, the first is liquidity. In the case of a REIT, the expectation is that you could buy the REIT on a Monday and sell it on a Tuesday. In the case of private equity funds, there's a directive given by the general partner that the funds will remain illiquid, potentially for up to a decade. As is the case for many long cycle illiquid assets, there tends to be a performance premium as the absence of liquidity allows for a longer investment hold, which suspends some of the performance limiting characteristics of a liquid asset. Second difference is fees. Private equity real estate funds tend to be a little bit more expensive. There's an ongoing management fee, as well as the sharing of profits of a fund, depending on how it's structured. These expenses could be worthwhile if a fund outperforms its publicly traded counterparts, or if it is able to mitigate risk in a meaningful way, or is able to create outsized income. If they don't, one should definitely question the fees. The third difference is transparency. In my experience, there's a reasonable level of transparency in both structures. In the case of a REIT, it has defined what type of assets the REIT is going to be investing in, and the regular SEC filings keep us up to date as to the activities. Also, we have a choice to invest in different types of REITs, as we mentioned before. If we want to buy a Class A mall REIT, for example, we can invest in Simon Property. If we want to buy storage units, we can invest in Public Storage Group. Keep in mind, these aren't recommendations, but they're just leaders in their respective spaces. And the same is true for private equity real estate funds. The sponsor or manager of the fund will invest in certain market segments, define it in their prospectus, and execute based upon that. What about performance? Well, generally speaking, as I mentioned, the absence of liquidity can lead to potentially higher returns for that private equity fund. And the reason for this is because longer cycle decisions can be made by the manager without regard to worrying about requests for capital backed by existing fund holders or liquidating for the purposes of a fund redemption. This expectation of illiquidity is set at the outset of the investment. What about the tax differences? Well, there aren't many tax differences between the two structures per se, and this is in stark comparison to individually held real estate, where there are multiple opportunities within our existing tax code to be able to execute certain tax strategies, including 1031 exchanges, depreciation recapture, etc. This doesn't mean that taxes aren't managed at the fund level, because they are. I'm referring to the tax management opportunities at the ownership level of individual properties and at the tax return level. Please keep in mind everyone's tax circumstances are different, and one should seek advice from your tax advisor for the impact that these instruments may have with your tax profile. So, which is right for you? Many investors, from the novice to the expert alike, believe that real estate should have a place in a well-diversified portfolio, as do we. If the decision to invest in real estate is appropriate, then the next decision is how to execute. If diversification is important, or your risk preferences allow for a small real estate allocation, then REITs might be a good choice. If your risk bandwidth is wider and you don't need the funds for a while, you may want to take advantage of the illiquidity premium, then private equity real estate may be worth exploring. And of course, we welcome this discussion with you, and we'll go over many other points that can't be covered in the 4-minute video. If you have any questions, please reach out to us by phone at 914-666-6600. Visit our website at samalinwealth.com or email us at success@samalinwealth.com. Thank you again for watching, and we wish you all the best.